What's up guys? Now we all knew that trading apps were powerful because they make it so accessible for anyone to enter the stock market. But I don't think that many people expected what is known as retail investing to become so influential so fast. And these apps have helped make that happen. And I'm sure that you all know what I'm talking about here. I am of course talking about how the internet this month shook Wall Street to its core and caused some of the most established hedge funds to lose $19 billion. Hey, it's Bret here, and in this video, I'm going to be talking about how investing could have changed forever and what that means for individual investors. Now, obviously, retail investing is nothing new, and individual investors have been around for a long time. And I'm not suggesting that all individual investors or retail investors use fintech apps like Robinhood, REVOLUT, and Webull. However, as of July last year, retail investors made up 25% of the stock market, and that's up from 10% in 2019. Now, that's insane, considering that the dollar value of trades made in one day on the NASDAQ alone is $365 billion. 25% of that is 91 billion, and that's 91 billion that retail investors are pumping into the market. And it's also during this time that these trading apps have become household names. And that, coupled with the growth of online communities such as Wall Street Bets on Reddit, makes it so much more feasible for retail investors to compete with the big guys, to compete with the hedge funds. And that's what we've seen over the last month with GameStop. There are a number of factors at play here, guys, so please watch the whole video to check them all out. And also, if you could take the time to scroll down and hit that like button, I'd really appreciate it. While you're there, why not hit subscribe as well? Let's go. First up is that there are fewer barriers to entry for individual investors, for retail investors, than there ever has been before. It's now so easy for almost anyone to pick up their phone and invest in basically anything. There's actually a historic trend as well, that whenever barriers to entry get reduced, individual investors flood the market. We saw this in the 1970s with discount brokers, and then again in the 1990s with the introduction of the internet. Even with the internet though, up until recently, it's still been pretty expensive and pretty complex as well for retail investors to get started. However, with the introduction of trading apps like Robinhood, Webull, and REVOLUT, we are now seeing these barriers reduced even less, because a lot of these trading apps offer a very easy to use interface, zero commission trading, fractional shares as well, and no minimum investment. These lower barriers to entry make it possible for people on lower incomes to get involved in what was traditionally reserved for people on higher incomes, for the wealthy to just get wealthier. In comparison, if you wanted to invest with a hedge fund, there's no such thing as opening an account, investing in a fractional share or half a share of Apple, half a share of Tesla, because these guys require a minimum amount to get started. Now, Wall Street are not happy about these trading apps, and that can only mean one thing, that it's a threat to them and an opportunity for us. If you ask me, these trading apps are an amazing opportunity for anyone to get started, to start building their wealth and start investing, instead of otherwise having your money sat in a bank account, which really only benefits the banks themselves. But please do be careful, because no one knows what's going to happen in the stock market. No one knew for sure what was going to happen with GameStop, and no one knows what the next GameStop is going to be either. Okay, the next point, and possibly the most impactful reason as to why the investment landscape, the investment dynamics have changed forever, is because of COVID. If COVID has shown us anything, it's that the internet is the most powerful thing in the world. Not that we didn't already know that, but it's made it abundantly clear. So many people have turned to the internet to make extra money leading up to the pending recession, which it's just a matter of time until it happens, because governments can't keep flooding cash into our economies and keep extending tax holidays and tax breaks. However, whilst governments do continue to do this, especially in the US, where the government is handing out stimulus checks, people are going to use that money to invest. COVID has also seen most interest rates slashed to about 0%, and there's even been talk about negative interest rates being imposed as well. And this is a monetary policy that basically means that banks could charge you to keep your money with them. And the whole point of this is to incentivize people to stop saving and start spending, because usually in harsh economic times, people tend to sit back, ride it out, and just see what's going to happen. So, as if it wasn't already bad enough to keep your money at the bank with a 1 or 2% interest rate, now if we're looking at the potential of being charged to keep our money at the bank, people are going to look for alternative ways to keep or spend or invest their money. And whilst the economic theory is that those alternatives will be spending on consumables, I think we're living in a time where more people will think twice before doing that. And that leaves you with two options. One is to withdraw all of your money and stash it under the mattress, and the other is to invest it. And that leads me on to my next point, which is the rise in popularity of retail investing. It's now seen as a cool thing to be an investor, to invest your money. And more people are becoming more interested in personal finance. There are also growing resources out there for people to learn more about investing, and social media is playing a big part in that as well. Maybe it's just me, but these days I can't even open my Instagram account without seeing tons of financial infographics. Whether it's Gary Vaynerchuk telling me about the latest credit card hacks or a chart showing Bill Gates' investment portfolio, these things are everywhere. I'm sure you guys are also aware of the emergence of frugal living and minimalism. These are two topics that have been trending in recent years. On YouTube as well, the amount of videos out there with these keywords in their titles is insane. Anyway, what I'm trying to say here is that all of these are linked to spending. There's a trend these days to spend less, which in turn means that people have more money, and if you're not spending that money on junk, it makes sense to invest. Right, now we're also living in a world that is becoming increasingly dominated by millennials and Gen Z. And us guys are more internet savvy, we're more inclined to start online businesses and take bigger risks. That is, compared to previous generations that put more emphasis in getting a good salary job and climbing the career ladder. Nowadays, people aren't prioritizing buying houses. Instead, people are opting to rent. Because whilst for our parents, possibly back in the day, it was a sure thing. Property was a sure thing. We're living in a different world now, and that's not the case. Now, property requires so much capital to be tied up, and there are so many other investment options out there. Having said that though, Forbes estimates that baby boomers are about to hand down around $30 trillion worth of assets in the next coming years. And a substantial chunk of that $30 trillion could, and if you ask me, probably will be used to invest, which means that more and more individual investors are going to become big players. At least as a whole, we're going to become big players and we're going to have more influence on the market. Millennials are also less likely to invest with a fund manager. In fact, a study found that 57% of millennials don't trust advisors. And actually, I'm one of those people. I believe that they're in it for themselves. They're sort of looking after themselves rather than their client. Now, it's also believed that travel is one of the main reasons why millennials save, and that millennials save more than previous generations. So with travel currently off limits, that's more reason for millennials to invest. So anyway, the way I see it, the big boys, the hedge funds and Wall Street are going to have less market share in the future, which means less control. Okay, now Bitcoin and other cryptocurrencies are also going to play a huge part in the future of investing. Bitcoin is already forcing its way into some of the S&P 500 companies such as PayPal and Starbucks, who are introducing Bitcoin transactions. As well, whilst holding dividend stocks has long been a favored investment strategy and one that I love as well, Bitcoin could be about to completely change all of this. The reason being is that there are companies out there like BlockFi that are offering insane interest rates for you to hold your cryptocurrency with them. We're talking anywhere between 7 and 10%. And 7 to 10% would be an insane dividend yield. So for those people out there who think that Bitcoin and other cryptocurrencies have no value other than what the next person is willing to buy it off you for, think again, because this space is evolving so fast. So what does all this mean anyway? Well, basically, as with anything in investing, nothing is for certain. But the days when Wall Street are able to manipulate the market may well be numbered, because retail investors are becoming more informed and they have so much access. And it's going to be interesting to see how Wall Street and the hedge funds respond to recent events with GameStop and AMC as well. We have already seen them call for retail investors to be more regulated, but personally, I believe that everyone should have the freedom to make their own decisions, because that's the whole point of a free market in the first place. Okay, so to conclude then, I do think when this erratic market flattens out, there will temporarily be a decrease in the number of retail investors, because it's not going to be as easy to achieve those FOMO gains that people are achieving these days. However, I think that will be temporary, and I do think that over the next 5-10 years, more and more retail investors are going to get involved. There's so much evidence to suggest this, and I think that that's what's going to happen. And guys, thanks for watching this video. Please subscribe if you're not already. Give this video a like, I really appreciate it, and I will see you next time.